Hi everyone, so that reflation trade continues taking some shine off the tech stocks. Tesla's got some serious threat on its regulatory credit revenues and the BOE decides. Alright, so let's go back to yesterday first. So it first looked like a softer than expected ADP report in the US would revive appetite in growth stocks, but no, that reflation winds returned very quickly to the marketplace, forcing the US big tech to erase their earlier gains and close the session in the red, while the Dow Jones Industrial Index advanced some 0.30%. So this is exactly how we reckon the reflation trade. Lower Nasdaq, higher Dow is a very good indication in this. So the next big test right now is Friday's NFP figure. So yesterday's data was weaker than expected. ADP data is weaker than expected, but still showed that the US economy added some 740,000 jobs in April, more than the previous months. So the expectation is a touch below 1 million non-farm job additions during the same month. We'll see on Friday. If nothing, the possibility of a strong NFP print should actually keep investors on the reflation side of the game for at least until the NFP read that we are going to see on Friday. Why? Because more jobs means improved revenues and soaring raw material costs on the other end. Global shortages, slow logistics all point at an acceleration in global inflation levels. Therefore, stocks that are poised to do better during higher inflation times is where long-term investors are now shifting their attention to. But short-term profit hunters are obviously on search of the new GameStop or Dogecoin-like gems to boost their earnings within a day or two, just to become rich as soon as possible. So it's risky, but it pays off well as well for those who manage to take the wave at the right time. The most important thing is here to avoid being among the latest comers. So keeping a close eye on what Reddit's Wall Street bettors talk about is maybe a good option, but don't forget that most of the discussion probably happens behind the closed doors on this end. So the risk is that by the time you hear about the new GameStop, a major part of the game has already been played, done and dusted, and some already made a good deal of money out of it. Anyway, let's see who's next after Microvision and Nokia on that end, but remain cautious. Just don't get too excited by these flash trades. Now, one place that investors clearly deserted as a result of this new hunt for new stocks is cannabis stocks. We see pot investors, darlings Tilray, Aurora or Canopy, remain under the shadow of more lucrative bets for the past couple of months, past weeks. We see signs of stabilizing in prices though, and some investors already start seeking some dip buying opportunities in the pot stocks to jump in before the mass of investors rush back into these companies' shares at some point in time. So if you're ready to accept some further downside correction in the cannabis stock prices right now, you could actually check out if the current levels could suit you for stepping in before everybody comes back. So one other company that we all love talking about and that we all love trading as well, Tesla. But there is some problematic news in the store for the world's most hyped electric car maker, and that's the side effects of a solid rise in competition from traditional car makers across the world in this electric car segment. So according to the latest news on Bloomberg, Tesla is now losing source of credit revenue that's been key to its profits. So what that basically means is that Stellantis, which is just your good old Peugeot and Fiat merged together, had an emissions credit agreement with Tesla to comply with regulation. So that basically means that they pollute too much and they buy credit from Tesla, which doesn't pollute too much. Well, that's a good deal. But now that they are going aggressively electric as well, it appears that the need for that advance on the CO2 emissions will no longer be. And apparently Stellantis is in a good position to achieve its CO2 emission goals on its own in 2021. That's this year. So when the agreement was first announced in May 2019, it was expected to generate some 1.8 billion euros for Tesla, meaning that it's not just a side issue. The amount at stake is quite big for Tesla. And if we think that the regulatory agreements bring hundreds of billions worth of revenue to Tesla each quarter, and we keep in mind that Tesla is still struggling to satisfy its own investors' ambitions from a revenue perspective, that fall in CO2 credit demand could be bad news. So Well, Tesla knew that the revenue from these regulatory agreements wouldn't last forever, so it was just a short-term play, but it's a double hit for the company, obviously. First, the electrification of the entire car-making industry will at some point tap into the demand for Tesla cars, obviously, and its profits. And second, Tesla will be losing the side benefits of being a clear, clean leader in the electric car industry. Well, news combined to the loss of appetite in growth stocks globally weigh on Tesla's share price at the moment and could soon push the price of a share below the 2-month uptrending channel that's somewhere below the $670 per share level. Obviously, bad news for Tesla. It's good news for Stellantis, which is catching up on the EV race and which saw its share price rally yesterday on that news. Other names that I'm closely watching are Volkswagen, as you know, which is now on a clear downside correction pattern after recording an impressive rally since last October, and that was on its aggressive electrification plans, remember. So I'm bullish. I remain bullish on European car makers on their efforts to electrify as soon as possible, and there is a lot of profit to be made in this area, in my opinion. So the only thing is that the Volkswagen's share price just rallied so fast recently that waiting for the end of the downside correction that we see nowadays and entering at an opportune time would be interesting, in my opinion. I think that we could well eye a further downside correction below the €200 level to start thinking about buying the stock again. So that's a place to keep an eye on, clearly. Moreover, we shouldn't forget that the inflation theme is also supportive of value names, and Volkswagen is clearly well placed within this reflation context. Now, speaking of that reflation, we also continue seeing a strong rise in oil and commodity prices nowadays on the index level. That's quite supportive of the FTSE index, which is heavy in energy and banking stocks. And I expect the FTSE to consolidate and extend gains above the 7,000p mark on this reflation theme. Now, US crude remains on track for a further advance towards the $68 per barrel level. And yesterday's weekly data showed that the US crude inventories fell 8 million barrels over the past week versus less than a 2 million barrel decline expected by analysts. So that's also being read as a faster recovery in the economic activity in the US and energy consumption. So this is all positive for oil and remains supportive of oil prices. Now, gold, on the other hand, looks poised for another test of the 100-day moving average resistance, which is just below the $1,800 mark. Again, the combination of soft US yields and rising inflation expectations globally is supposed to be a blessing for the yellow metal. But we don't see that these days, with the fact that other commodity prices are now hovering around a decade high levels could finally drive some capital toward your good old gold, and prevention of higher inflationary times is the $1,000,000 question. Okay, now a quick word on FX and the Bank of England meeting today. If you're looking globally in the FX market, the stronger US dollar is also a clear side effect of the inflation theme of the moment, as rising hawkish Fed expectations should give some material support to the greenback. Now, those gains in the US dollar remain on a slippery ground still, as the data says one thing, but Jerome Powell says a complete different thing. So who between the data and Powell would convince traders and investors to go one way or the other is another $1,000,000 question, obviously. It's a sure thing that a strong US jobs figure on Friday could shaken Jerome Powell's dovish positions, as Yellen did earlier this week, saying that the interest rates may somewhat go higher, and a strong US jobs data could give some more evidence of tighter financing conditions in the US sooner rather than later. Therefore, I expect to see a strong US dollar appetite at least until the Friday's US jobs data release, and in this respect, we could see a further retreat in the euro dollar below the 120 mark toward the 119.45 level, where the 50-day moving average now meets the 200-day moving average for an eventual death cross formation, which should also give a hand to the medium-term euro bears from a technical standpoint. Now, across the channel, the Bank of England is expected to stay pat on its own monetary policy meeting today. today. So it's worth keeping an eye on the PMI figures in the UK to understand the impact of the business reopening after the COVID crisis on the UK's growth prospects. Now, cable remains just below the 140 mark right now, and the MPC has quite mixed feelings over whether to start tapering massive bond purchases now or wait until the summer before tightening its purses strings. Now, it's sure that the taper talk will need to happen at some point in the very foreseeable future in the UK as well, but it's also better to see the recovery on the right track before taking a concrete action. But the fact that the Fed remained quiet on that taboo taper talk could also encourage the BOE to stay quiet for at least another month, so it could be better maybe to follow the US lead on the taper arena for now. A hawkish take from the BOE meeting, on the other hand, should send the GBP US dollar above that 140 handle, although I expect that the US dollar strength could somewhat limit the upside potential in cable for a couple of more days or weeks. This is all for today. I'm İpek Özkardeşkaya, and thank you for joining me. I hope this episode of Market Talk has been helpful and insightful to you. Please do not hesitate to follow us on Twitter and on LinkedIn for regular market updates, and subscribe to our YouTube channel for daily market comments. I'll meet you again tomorrow, and until then, good day trading.